Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Brian B., Jeff S., Dave V., and Joe G. We have a returning guest on the program today. Mr. Brad Docherty is with us on the program. Brad is the president, CEO, and chairman of Source Rock Royalties, a Western Canada-focused oil and gas royalty company that has revenue-generating royalty streams on producing operations in Alberta and Saskatchewan that allows the company to reinvest on growth initiatives as well as pay steady dividends to shareholders. Source Rock Royalties is the only publicly listed pure-play junior oil and gas royalty company in Canada. Source Rock Royalties is listed on the Toronto Venture Exchange under the symbol SRR. Brad, welcome back to SmithWeekly Discussions.
Andrew, thanks for having me back.
Good to have you back on. And of course, things certainly have changed out there in the markets. And it's been, I was just checking here, it was about 6 months since we last talked. And the company, of course, has had some good progress to start the year. Of course, we'll get to that in a moment. But first, let's go to the market conditions, because that's definitely a key factor here. And some of the changes out there with geopolitics and the oil market. Of course, we could get into junior sentiment as well out there and Canadian market sentiment, but maybe we'll leave that for a moment, just focus on the geopolitics and the oil market. What are your thoughts out there as far as how things have behaved so far this year? And maybe there is some opportunity that lies ahead. Give us some of your opening thoughts there.
Yeah, definitely a changed landscape from 2024 with all the the talk of tariffs and the resulting trade war dynamic and factors that have directly and indirectly influenced oil prices. Obviously we've seen oil come down materially in the last couple of months, and so that has a few results. Is that there's direct results on our business in terms of oil prices are lower, which means price realization for our royalty barrels will be lower. Ultimately, that also creates uncertainty in the sense of operators of royalty lands don't have as clear a direction on the path forward of their activity levels. So again, that's really the fallout of oil prices coming down directly, and then the indirect effect is more the the tariff talk, the market uncertainties, more macro factors. And companies just not wanting to be as aggressive in their plans for the year ahead because of those uncertainties, and again, uncertainties around tariffs specifically, which again would direct price realization, but also just the more market uncertainty generally. And I think purse strings tighten up quickly when there's macro uncertainty and simultaneous commodity price declines. And so it's definitely a changed landscape from 2024, where we had quite healthy oil prices for the most part of the year, and really kind of a calm landscape in the Canadian oil and gas space. So that again, not entirely rosy dynamic that's been created through all these trade war and tariff conversations. But ultimately, our business is well positioned with with a strong cash balance of greater than $5 million now, which is 11 cents per share, and a very low cost structure that we've always maintained. And so we'll continue to be looking to opportunistically take advantage of the changed market dynamics to expand and diversify our portfolio. But obviously, we're very cognizant of the fact that activity levels on our royalty lands for the year ahead may not be consistent with activity levels in 2024, and also oil prices have lowered, which has a direct impact again on our royalty revenue. So definitely navigating the changed market dynamics, but also looking forward to seeing what positive opportunities come out of it.
Good thoughts. It certainly is a bit bumpy out there, and you've witnessed this a number of times in your career, and also with this company, you've seen some of these downdrafts that we've seen, and some of the recoveries and some of the things that happens. It's not always on the same set of events, but certainly there are some rhythm and rhyme to it, if you will. And I think also too, as you said, there could be some opportunities that lie ahead here as you guys rescan, reposition a little bit as in terms of what you're looking at out there for growth opportunities for the company. I want to get into some of the recent updates. Of course, I'll remind the audience that SourceRock does pay a monthly dividend, and you can, of course, see that history of dividend payments by reviewing company filings, or in most cases, your broker or a financial data website would have those details pretty accurately. But Brad, now that we're just talking here on year-end results, and of course 2024 results came out recently for the company, highlighting some pretty good growth over the 2023 fiscal year. On some metrics, we saw double-digit growth. Obviously, that was in part a factor of company-specific efforts on your behalf, and then also some oil market price metrics as well that help play into that. But talk just briefly a little bit about the 2024 results and some of the key areas that you want to point out.
So 2024 was a record year for us annually across the board: record production, record revenue, record adjusted EBITDA, and record funds from operations, which is free cash flow for our business. That strength was the result of 2023 acquisition efforts, which we'd done about $16.5 million from November 2022 to December 2023 of acquisitions. And so we really had 2024 as the first full year of all of those acquisitions being in our portfolio. And then we saw really strong drilling activity. And so again, we did no acquisitions in 2024. We though saw really robust drilling activity that outpaced our expectations, and that drove production growth and obviously revenue growth. And so, it was a really strong year. We had just under 7.7 million of revenue, based on 251 BOEs per day of royalty production, which was 95% oil. Pricing year over year was down 5%. So you can really kind of see that revenue growth was driven by the 21% production growth year over year. And then, importantly, though, we ran the business on strong capital efficiencies. We only had a 2% increase to our costs to run the business. Our tax year over year did go up, which grinded free cash flow a little bit, but that's to be expected where revenue is ramping up, and we're not doing acquisitions, because then we aren't building any tax pools through those acquisitions. So all in all, it was an extremely strong year for us, very robust, outpaced our expectations materially. But again, as we've mentioned, we're now kind of finding ourselves in a different landscape in 2025. But I think 2024 reflects the strength in the business, in that, we can sit back and benefit from drilling activity on our lands when oil prices are strong, and we don't have to be increasing our cost structure as that activity is happening. Again, we have no direct exposure to that, the cost of that drilling activity, and we can ultimately make sure that we're paying a healthy dividend to shareholders on a manageable payout ratio, which for 2024 was 58%. And then again, I think the most important factor coming out of 2024 is that our cash balance grew materially. So it increased by over 200% during the year. As we sit here today, we've got ourselves positioned with greater than $5 million of cash, as I mentioned, which is 11 cents per share, and really positions us to have a wide opportunity set of acquisition opportunities, both small and now getting a bit larger, to be able to pursue with our cash balance.
Brad, and I want to come back to the last point you made there. You guys have been much more disciplined and careful in a higher oil price environment with respect to proper acquisitions to grow the business. Now in 2025, we're starting to find ourselves more on the downside of that end of prices. With the cash balance that you guys do have, as the opportunities start to present themselves in this lower price environment, talk a little bit about how you're going to manage that dividend against maybe some of the opportunities that you guys are going to evaluate. Of course, these things take time, so price is going to fluctuate quite a bit while you guys work on these transactions. Just talk about how you manage that dividend payments versus using some of that cash balance for a potential acquisition, because there might be a good deal out there due to the market conditions.
Yeah, so our business has always been a balanced growth and yield approach. And so, we've wanted to always simultaneously provide that strong dividend yield, while at the same time executing on growth with excess free cash flow and or our cash balance. And so, we have that $5 million of cash is arguably available to deploy on new acquisitions entirely. I mean, we shouldn't we shouldn't be needing to rely on our cash balance to pay the dividend. That should be covered by cash flow. And if the markets get dire to the point of not being able to cover our dividend with cash flow, then obviously we'd be have the backstop of our cash balance, but the goal is obviously not to be using our cash balance to pay the dividend. The goal is for it to be funded from free cash flow. And so, then really we should be able to look at our cash balance as fully available to deploy on acquisitions and create non-dilutive growth. And so, that is always the goal and continues to be the goal. The opportunity set in the current market is somewhat continuously expanding as our cash balance grows. It does open some opportunities that were not available with a lower cash balance. There is always opportunities to do smaller deals, but I think in this market we'll likely find ourselves being more drawn to opportunities where we're helping fund an acquisition of an operator and being able to move the needle a little bit for them with our larger cash balance. But we are always looking at broad suite of opportunities, smaller and medium sized and larger. And so, we're not fixated entirely on one size deal or one type of deal. I think that we are continuously utilizing our network to have conversations around what opportunities are out there. We're very prudent though, in the sense that, we don't want to be doing deals for the sake of doing deals. We don't feel a lot of pressure to react to the market. And so, although we would expect 2025 to be less robust of a drilling year, and, see some of the drilling activity and flush production from that drilling activity in 2024 result in declines in 2025, the business is set up where, we can navigate these roller coaster conditions, and we really are fixated on making sure that the company is doing high quality deals on the right terms for long-term value creation. So, again, after 12 years of building this business and seeing oil prices crash, four times at least, with some mini crashes along the way, we do find that these types of market conditions are better suited to be deploying capital in, as long as you can find deals with counterparties that are well positioned to navigate these types of market conditions, and ensure that we aren't doing deals on assets that then get in the hands of struggled operators, or the operators can't follow through on the contractual commitments they're making to us relating to the assets. And so, there is really a multitude of factors that go into the opportunity set. But I think at a base level, our cash balance is there to be deployed on new acquisitions. We want to be diversifying and expanding our portfolio of royalties in times where oil prices are not extremely robust. We just have to be cognizant of the market conditions that we're buying in, and what that might result in terms of less activity on the lands going forward.
I think that's an important distinction to point out there, just as far as how you're managing both cash flow, dividend payments, maintaining that dividend, but then also that good opportunistic event where you have a good chance at a great price to grow the business. And obviously you've done that in the past. You guys have already demonstrated some of those moves in the past, and I'm sure you're out there looking, and more so looking now, in some of the conditions and some of the opportunities that come about during these low price periods. With that, we talked a little bit at the start about, operators making different decisions about their plans for the year, their production plans, maybe reducing activity based on prices. Every operator is a little bit different. They have different cost profiles. But in general, just talk a little bit about, based on the conditions today, I think we set this straight for the audience. Expected production. I know this is super hard to estimate, and that you guys won't be putting out any formal guidance, and you typically will not do that. But in this uncertain environment, just talk about, some of the commitments that were there on the existing portfolio, and stuff that maybe you would expect to come online in the play areas into 2026. Why don't we give it like an 18-month period here? Just talk about some of your expectations and current market conditions as to how you would see the production profile changing over that period of time.
Yeah, so typically as a royalty owner, we don't have any direct guidance on drilling activity levels or timing on our lands. Having said that, we've done various deals over the last couple of years that had drilling commitments associated with those transactions, where the operator was committing to drill a certain number of wells over a certain period of time. Now, a couple of those drilling commitments were satisfied in 2023 and 2024. We have one drilling commitment remaining, which is on our Figure Lake Clearwater royalty lands with Rubelite Energy. We did that transaction in December of 2023. They committed to drill 59 wells on those lands by June of 2026. As far as we're aware, they've drilled 19 wells on those lands so far. So there's approximately 40 wells left to be drilled in the next kind of 12, 13 months. And so that's a lot of activity over a short period of time. And, we would expect that there's going to be fairly consistent activity on those lands, but unlikely to be robust to that level. There are some qualifiers in that drill commitment. If oil prices, WTI oil prices are below $60 for consecutive periods of time, then there are some extension mechanisms in the agreement to that drill commitment. But that is a property that we would expect some consistent activity on still. Obviously, they're going to be managing the timing of that activity relative to oil prices. And so, again, we expect operators to be prudent in their approach to drilling and not to be drilling what are typically high rate of return wells with strong initial production in a low price environment. And so, we expect and want our operators to be drilling wells to maximize return for not only themselves, but us, because we want that flush production from strong drilling to be coming on in a higher price environment. And so in the current market landscape, we would expect drilling activity to slow materially unless that drilling activity needs to happen to continue lands or manage other obligations that are there relating to the lands. And so, again, 2025 and going into 2026 is going to be quite uncertain from a drilling activity standpoint if we find ourselves in a high 50s WTI price environment with lingering macro factors creating uncertainty. And so that is kind of our base case expectation, is that drilling activity for 2025 is going to be lower and levels will be quite uncertain, but there will certainly be activity still happening at times. And that's really fine with us because, again, we want to be maximizing value in our royalties. And that requires drilling, especially the initial production that comes from drilling, to be happening at a time when oil prices are strong. And so, again, we are built as a business to navigate the ups and downs in volumes and prices. I'm the only employee of the business still, despite the growth that we've achieved recently. And so, for us, we want our operators to be prudent, to be drilling these high rate of return, locations when they view them best to be drilled. And so, again, we expect that to be a quieter story in 2025. And we don't expect growth through drilling in 2025. And we would be more focused on achieving growth this year through the acquisition strategy and utilizing that cash balance.
Brad, that's good to cover off, and I think that kind of sets an expectation here. There's other things you guys will be able to work on here to help frame some of this, but certainly market conditions playing a big impact here in operator decisions. Hopefully more of those come on here with some of those commitments. It's good to see that, but of course we know the economics can impact those commitments to a certain extent as well. So appreciate you covering that off. On capital structure, Brad, we've already covered current cash, so I think we're good to go there. But I want to highlight again for the audience, I think this is important to point out. We don't see this that often in the junior markets in Canada, but I think it's important to point out again for the audience the insider ownership and the respect you have given the share structure in terms of no free shares, good cost basis, and full alignment with the outside shareholders.
Our share count increased 1% year over year from end of 2023 to the end of 2024. That was really just some incentive securities being exercised by board and management. And so, we have maintained our share count to be very, very tight and stagnant since our IPO, and really haven't issued shares since our IPO. And ultimately, we like to really run this business in the way that it's maximizing value for shareholders, because we are large shareholders, as you referred to. So I myself own 5.5% of the company now. There's no cheap founder shares out or anything. So, I purchased my shares over the years, or taken them as compensation in lieu of salary, and so I'm very aligned from that perspective. With the rest of the board of management, we own just over 10% of the shares outstanding. Our average cost on those shares is higher than the current market price of the business. And then we also have CN Rail Pension Fund, who continues to own 20% of the company. They have been a shareholder since July of 2014. And again, they have an average cost above the current market price. And importantly, we like to point out that not a single insider share has been sold since the company went public 3 years ago. There's been some fairly consistent buying by myself and some other directors, and so we are really aligned here, and we're looking to maximize shareholder value, which will ultimately maximize value for ourselves as well. And we want to maintain a prudent approach to the capital structure, and don't want to be issuing shares and creating dilution just for the sake of it. We'd only be looking to do that if there was an accretive event happening that required extra capital, and we could be confident that on the back end of that deal, we're creating additional value on a per share basis by adding that dilution. And so otherwise we'll be looking to use our cash balance and our balance sheet to create per share growth, and compound the exposure of the existing shares to the growth in the portfolio.
I think that's really important here to point out to the audience. Folks should take notes there, and just how you guys have set up this capital structure to where you are fully aligned. Again, I want to reiterate that when you look at the junior capital markets of Canada, you often see a lot of abuse of capital structures. And so I just want to re-highlight that for the audience. How Brad has approached this is quite good in our opinion. And so just wanted to cover that off. With that, another piece that come in here, I think that's important, audience question here that came in. I think a key part here too, Brad, is how you guys are approaching both the dividend and then also the possibility of a normal course issuer bid should the company have excess capital after expansion goals, royalty acquisitions, base dividend, et cetera. Would there be any opportunistic circumstances where the company would buy back shares should the valuation be meaningful to do so, Brad? And if not, just talk about why you wouldn't do that, because I think you have a very good strategy here.
The dividend is a core component of our business. I mean, we initiated our first dividend in Q1 of 2014, and then ultimately have paid a dividend ever since then, with the exception of Q2 and Q3 of 2020 when COVID was ramped up. And so, we've paid back over $20 million now in dividends since 2014. That's 66 cents per share for those shares that were issued as of Q1 2014. And we've paid just under 23 cents in dividends to our IPO shareholders from March 2022. That's a 90-cent IPO shares. So again, it's a core component of our business. We feel like in a volatile industry such as oil and gas, we need to be providing that consistent return to our shareholders. But again, not at the expense of growth. And that's why we have the business structured the way we do from a cost standpoint, that so we can recycle free cash flow and again grow our asset portfolio and create the growth wedge alongside the dividend. So having said that, though, to the NCIB comment, I think our focus is on being that growth and yield vehicle, which means providing a consistent yield but growing our portfolio of assets. And so, we do want to be focused on expanding and diversifying our portfolio of royalties, as opposed to buying back shares and forcing shareholders to be more exposed to our existing portfolio of royalties. And so our focus will be on paying the healthy dividend that we've been paying, and then utilizing our cash to, again, diversify and grow our portfolio of royalties, which ultimately, in doing so, is kind of de-risking the business further for shareholders, in the sense that we can expand and diversify our asset base, our operator exposure, improve our existing production profile, and also increase our exposure to undeveloped land and ongoing drilling activity without increasing our cost structure. And so, net, I believe that our shareholders are better served longer term by us, again, using excess free cash flow to put into more asset acquisitions as opposed to using excess free cash flow to acquire shares through an NCIB. We also, have the view that, we are continuously looking to expand our shareholder base. And, in order to do that, we require, consistent liquidity and availability of shares for sale so that new shareholders can come into the story. And, if we were kind of backstopping, the bid through an NCIB, we would ultimately be soaking up some of those shares that might otherwise be available for new shareholders to be purchasing. And so, I think that's another aspect of it, is that as a tightly held entity, we don't want to be taking away liquidity for outside new shareholders as well.
Yeah, that's a good point. It is a tight capital structure already in it. I mean this in a good way, Brad, but it does trade by appointment. Another key area that I think is important for people to understand when you have to weigh these different strategies and approaches, how you're doing it. And I know you've thought a lot about this and have implemented a pretty dang good strategy since inception of the company. So I appreciate the comments there. Wanted to talk just a little bit on acquisitions, Brad. I know acquisitions is sensitive, so any insights you can provide is appreciated. And of course, I don't want you to get into giving away any trade secrets on a podcast, but any plays of interest in the region of Alberta or Saskatchewan that, given current oil prices, your appetite level for deals has increased. Any insights as to areas of interest and maybe some of the areas that you would look just on a broad basis? We don't want you to give anything away because we don't know that there's other companies out there listening in.
Yeah, so our focus on acquisitions will continue to be on the oilier parts of the basin. So we don't anticipate that we would, jump into, the gassier parts of the basin and try to, shift our weighting of oil versus gas. So, we do intend to continue to be the oil-focused royalty company in the basin. Really, a couple of factors there that drive that is that, we want to, be exposed to the highest margin product, which typically has been oil as opposed to natural gas. But also, it's really more our relationships are more largely in the oilier parts of the basin from a team perspective. And so, in terms of identifying opportunities for acquisitions, that is really, a relationship driven exercise. And so, we find ourselves having success in finding opportunities over the years in Southeast Saskatchewan, West Central Saskatchewan, and then East Central Alberta, and now we've done a transaction in the Clearwater, and we'll be continuing to look for further opportunities in the Clearwater. Ultimately, Southeast Saskatchewan is a shallow oil, Frobisher focused, fairway at this point. There's also other formations being developed in terms of Mydale and other targets. But the opportunities that we've been finding with counterparties has been largely focused on the Frobisher. The Clearwater, again, as I mentioned, is certainly continuing to be interesting for us, and we'd love to do more transactions in that fairway. And then there's a lot of opportunities and a lot of activity happening in the general Mannville stack is the term that you're probably hearing out there in the market in East Central Alberta and to some extent West Central Saskatchewan. And so, ultimately we would be looking to, get exposure to that region as well with the right counterparties and the right opportunity set. But I think importantly, what we do needs to have enough margin to be comfortably doing a deal where, that you can have comfort that your operator is going to be able to navigate a low price environment without the royalty that we are creating, squeezing their margins too much. Or if we are looking at an existing portfolio of royalties, we would want to make sure that those royalties that we're buying are not impeding the operator's ability to make money in a low price environment. Because ultimately, again, there's lots of margin in oil typically, but that gets squeezed quickly with op costs and royalties, and that when you see really aggressive downside in pricing. So, we continue to be focused on our royalty partnership transactions where we're working with existing operators to create a royalty and be granted a royalty in existing lands and production that they have, or helping them fund an acquisition of a new asset and taking a royalty in that new asset. But at the same time, we are continuously looking for existing royalties that we can acquire on attractive metrics. They're just less attractive for us as a whole, because we're not creating that working relationship with the operator when it's an existing royalty. We're really buying a royalty from a third party. The operator is then inheriting us as the party they have to pay the royalty to, but we don't have that dynamic where we're partnering with an operator to give them capital and to have them develop the asset. So we just like the partnership approach a bit more in the current market, because we can get a little bit more comfort on what's going to come on the asset in terms of activity and optimization efforts. And again, we'd like to have that repeat deal flow through those partnerships. So again, broad opportunity set. It will be oil focused. Again, targeting partnerships and continuing to build out that aspect of our business. But ultimately, we need to ensure ourselves that our royalty or the royalty we're buying is not impeding economics too much on the assets.
Very good. Good information. Appreciate you sharing those insights there. And then, of course, the focus on oil and not gas. Wanted to just back up, I guess, on one thing before we finish up on a few items. With respect to infrastructure, pipelines, I know that's another issue that's been ongoing. Any comments broadly, just as far as the regulatory environment and also, potential pipeline construction, which obviously would start to ease some of the Canadian exports? Just any broad comments there as far as infrastructure.
Yeah, well, obviously with Trans Mountain coming online recently, that's obviously opened up a lot of outflow of oil capacity for the market, and so my understanding is that Trans Mountain is still not full, and so ultimately it seems like the basin is well positioned in terms of being able to have sufficient takeaway capacity. We don't obviously directly have involvement in the infrastructure side of the market. I think there was obviously a lot of hope through the recent Canadian elections that a government would come in that was going to broadly open up new pipeline projects to really ramp up takeaway capacity. That obviously didn't happen. Hopefully the new government is more open-minded than the last one to the projects that make sense, and ultimately, as Canadian oil production grows, there will be a need for continued takeaway capacity growth. But right now, the market seems fairly well balanced, I would say. That's reflected in the differentials on oil prices. Heavy oil differentials currently are under $10. That historically had been north of $20 for a large period of time before Trans Mountain came on. Light oil differentials are really low as well. The most recent numbers I saw was sub $2, which can sometimes get as high as around $5. And so those really historically low price differentials on both heavy oil and light oil are very reflective of a balanced market from an infrastructure standpoint. Now obviously we found ourselves in a new oil price environment that I believe will slow growth of oil production in Western Canada as well if we stay in this type of oil price environment. And so again, I think that then translates into a continued balanced market. The question becomes, if we find ourselves in a high oil price environment again, and we're seeing $100 plus or $90 plus Canadian price realization on oil, well, that could then translate into a real ramp up of production growth in Western Canada. And ultimately, if Trans Mountain is the only new source of outflow capacity, you certainly could see a limiting factor there in terms of that growth may not have a way out at some point, and there will need to be renewed activities on the infrastructure build out to support that oil production growth.
A few dynamics there at play, where Alberta, for example, I mean, we know Alberta it's reliant upon other provinces and regulatory policy to allow these pipelines to be built. At the same time, the province carries a lot of other provinces with regards to tax contributions and these types of things. There's an interesting dynamic here, because when you have a good oil market and you could build out infrastructure, that can improve the cost profiles generally. So I think that's an interesting point that you brought up there, just with respect to how you're looking at the infrastructure side of things and some of the dynamics at play here. It is well positioned, and if we could get some additional infrastructure done, that would certainly impact the cost profiles, which would flow down to Source Rock as well as to how their profile looks with respect to royalties and some of the deals that they would do out there going forward. One other thing, just on sensitivity, coming back here to the market just a little bit again. Sensitivity data, you guys put out a document on sensitivities found in your company overview documents on your website. Just talk a little bit about that in terms of how it stands right now and also how that looks on a downside basis should oil prices dip a bit further from current prices.
Our analysis on sensitivity is currently based on production rollover and downside in oil. And so what we show in our presentation is a scenario where current royalty production rolls over from the 250 BOE a day level that we saw in 2024 to 200 BOEs per day. And then we see oil rolling over to $60 Canadian price realization. So in that scenario, again, 200 BOEs per day of production and $60 Canadian price realization, we would view our dividend as hitting 100% payout ratio. So obviously downside protection there in terms of both production rolling over and pricing. But we're not far off from that from a price realization standpoint today, given the weakness we've seen. And so, again, it will be something that we are going to have to navigate and manage in the sense that, we run the business in a very simple, cost efficient way so that we can navigate market circumstances. And so that scenario of 200 BOE per day from 250 last year and $60 Canadian price realization from the levels we were at last year, which was about $84, $83.50 average for the year. Ultimately in that scenario, that assumes we don't adjust anything from a cost structure standpoint. And that also assumes that we don't complete any acquisitions. So, we feel quite comfortable with, the downside protection on the dividend. But again, obviously, we've always run this in a way that allows us to navigate and adjust and deal with market circumstances that come at us. And so our goal will continue to be maintaining that dividend and to be expanding and diversifying our portfolio of royalties so that our dividend has more protection from both the existing production profile standpoint and the exposure to ongoing drilling standpoint. Because again, that dividend is an important part of our business model. And so we need to be acquiring new assets, exposing ourselves to increased production and growth in order to be consistently paying that dividend through the ups and downs in oil prices and market conditions.
Yeah, it's good to highlight investors here in the company and folks considering the investment. I think overall you're in pretty dang good hands here with Brad at the helm as far as the direction of how this gets navigated and some of those downside pressures that could come here in the coming year, what have you, with some of the issues that we're seeing out there that everybody's well aware of. Short of any other comments, why don't we leave it there for now? I just want to have you finish up on this last question as we customarily close out with. For potential investors out there who are listening in, the company has a market capitalization of about 38 million Canadian dollars. Why should Source Rock Royalties be considered within the institutional, family office, retail investors portfolio at this point?
We run the business in a way that allows our shareholders to benefit from the ongoing cash flow that the business generates, but also continue to get exposure to a growing, diverse portfolio of royalties that's managed in a shareholder first way, in the sense that we're not growing the business to then grow across a cost structure behind it. And so I think we're positioned today where we have an existing portfolio that is diverse and benefiting from oil prices that are still decent in the context of the Canadian dollar price realization we're receiving. But we're now in a market where we can utilize the cash balance that we've built to some extent benefit from whatever direction oil prices go. And so ultimately, if oil prices shoot higher again, well, that's going to benefit our existing royalty revenue and drilling activity on our existing royalty lands. If oil prices stay where they are today, then we'll have continue to have decent royalty revenue and production from our lands, and have a fairly attractive acquisition landscape to be deploying that capital in. And if oil prices go lower, obviously that will, impede the activity on our existing royalty lands, and ultimately squeeze the royalty revenue that we're getting near term. But that will create again an even more attractive acquisition environment for us. And so we really do take a long-term approach to building out the business and creating returns for shareholders through that balanced growth and yield approach. And I think that ultimately we recognize that there's ups and downs, and we're always going to be looking to, again, maximize the returns for shareholders through those cycles, in the context of benefiting from the drilling and high oil prices when they're there, not being a capital deployer in that higher price environment, and then look to deploy capital and build our portfolio out in a lower, more attractive price environment, to then benefit from the next run up in oil prices.
I think it's important too to highlight that this is the long game here for investors. While there's both dividend, get paid while you wait essentially, and also that growth strategy implementation that's done in a very disciplined fashion. I think investors can appreciate that. But for folks out there looking for a quick overnight flip, this is definitely not the one. But if you're in it for the long game, you're looking to diversify, earn income, and take this for both the income and also the growth that Brad is putting together, I think it's a very ideal position here to take a look at current prices today for the company. Brad, for further information, how can interested parties reach out to the company?
Yeah, so certainly we have a robust data set on our website at www.sourcerockroyalties.com. Certainly, I'm always welcome to receive inbound emails at brad@sourcerockroyalties.com. Happy to engage with shareholders directly to answer questions and give further insights on our group and our business and our long-term approach to building things.
Brad, it was great to have you on again to have an update here. Looking forward to seeing more progress in the coming months, and we're also looking forward to having you come back in the fall to update.
Thanks very much for having me back, Andrew. All the best.